FirstRand's posted high annual profit. The lender has reported a 4% rise in headline earnings. It cited a strong second-half performance and says that helped it absorb an accounting provision related to a UK probe into the vehicle finance market. FirstRand lifted its dividend for the period by 8%. CEO Mary Vilakazi meanwhile says the group expects the macroeconomic environment in the territories that it operates in to remain challenging in the year ahead. Weak PGM prices have weighed on Sibanye-Stillwater. The precious metals mining company has slipped into the red and has reported a half-year loss of over 7 billion rand due to an impairment of 7.5 billion rand. Sibanye says that's mainly due to lower medium to long-term forecast palladium price assumptions, which resulted in a decline in expected future net cash flows. The firm's added that it will roughly halve its US mined platinum and palladium production next year, leading to about 800 job losses. Discovery has flagged a rise in headline earnings of up to 9%. The financial services groups released a year-end trading statement saying Discovery SA performed strongly with a compelling contribution from each business in the composite. It's added that Vitality UK achieved a strong growth in customers, new business and earned premiums. Discovery is set to open its books next Thursday. Lesaka has delivered an improved year-end performance. The fintech company has narrowed its net loss by 48% to 326 million rand. Its Southern Africa CEO Lincoln Mali says he is particularly pleased with the consumer division's performance, which posted revenue growth of 15%, and has added that hard work has gone into turning that unit into an important profit and a cash flow contributor. Capital and Regional's takeover talks with New River REIT are ongoing. The UK shopping centre owner has asked for another extension regarding a bid deadline, and that request been approved by the UK's panel on takeovers and mergers. New River is now required to make its intentions clear by 6 p.m. on the 26th of September. And that means it either has to make a firm offer for Capital and Regional or announce that it's stepping away from a potential takeover. South Africa's inflation rate is expected to slow. Analysts, business people and trade unions have further lowered their inflation outlook in the third quarter. That's according to a BR survey, which is a key data point for the central bank at its monetary policy meetings. The three groups expect inflation to average 4.8% over the next 5 years. This is slightly lower than the 49% they expected before. Those findings are said to have reinforced expectations that the SARB will consider cutting rates next week. Mining outputs declined again. Production for July dropped by 1.4%. This marks the second consecutive month of contraction after June's near 4% decline. The largest negative contribution came from the iron ore sector. FNB senior economist says the recovery in mining activity is expected to remain moderate in the near term. That's despite easing energy constraints and a stable global growth environment. He's added that ongoing inefficiencies in the port and rail industries continue to hinder productivity and profitability. Construction activities picked up. Afrimat's index, which is focused on the sector, showed an improvement in the second quarter. It's registered an increase of 8.8% as 7 of the 10 indicators that make up the ACI turned positive during the period. Rolof Botha, who compiles the index, has flagged the year-on-year performance. He says the decline of 1.9% on that basis is unfortunate, especially against the background of a need for housing development and the associated infrastructure. Further afield, Samsung Electronics, the world's top maker of smartphones, TVs and memory chips, is cutting up to 30% of its overseas staff at some divisions. For more detail, let's take a look at this report.
Samsung plans to cut up to 30% of its overseas staff at some divisions. Reuters exclusively revealed the news after speaking to sources. The world's top maker of smartphones, TVs and memory chips has told subsidiaries worldwide to reduce sales and marketing staff by about 15%, according to two sources. They said it has also called administrative staff to be reduced by up to 30%. One source said the plan will be implemented by the end of this year and would impact jobs across the Americas, Europe, Asia and Africa. In a statement, Samsung said workforce adjustments conducted at some overseas operations were routine and aimed at improving efficiency. It said there are no specific targets for the plans, adding they are not impacting its production staff. Official data showed Samsung employed 267,800 people as of the end of last year, with more than half based overseas. A source said the so-called global mandate on job cuts was sent about 3 weeks ago. The cuts come as Samsung grapples with mounting pressure on its key units. Its chip business has been slower than its rivals in recovering from a severe downturn in the industry, and profits at the unit hit a 15-year low last year. In May, Samsung replaced the head of its semiconductor division to overcome a chip crisis. It aims to catch up with smaller rival SK Hynix in supplying high-end memory chips used in artificial intelligence chipsets. Samsung also faces tough competition from Apple and China's Huawei in the premium smartphone market. It was not immediately clear if Samsung will also cut jobs in its headquarters in South Korea. Job cuts could stir labour unrest at home, and one source cautioned it could be a politically sensitive issue. A South Korean workers' union at Samsung Electronics recently went on strike for several days, demanding higher wages and benefits.